Hey everyone, welcome to Alpha Insights. I'm Archer, here with Hope.
And I'm Hope. Great to have you with us. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
Today we're chewing over a small beverage company that just flipped the script on skeptics. Cizzle Brands posted its first positive adjusted EBITDA quarter, and revenue shot up 253% year over year. So, the obvious question is, what does that actually mean for the business?
Right. On the face of it, that combination, a big revenue pop and the first quarter of adjusted operating profitability, is exactly the kind of inflection investors in this space watch for. But the bear case has been loud. The company took on meaningful debt. So is that leverage a problem or not?
It's an important distinction. First, you have to separate survival debt from acquisition debt. Survival debt is what you borrow to cover losses and payroll when the business can't support itself. Acquisition debt is financing you use to buy an asset that generates cash. In Cizzle's case, most of the debt bought a factory.
Exactly. They acquired the former Flow Water co-manufacturing business, now their Seawench hydration factory in Aurora, Ontario, and financed it with a senior secured facility and a vendor takeback. So the debt wasn't to plug holes, it was to buy a revenue-generating machine.
The financing terms raise eyebrows, though. The senior facility carries a 12% coupon, which sounds high. But here's the nuance. Interest early on is paid in kind, meaning it's added to the loan balance rather than taken out of cash flow. That gives the newly acquired factory breathing room to scale before cash interest hits the bank account.
And the vendor note is structured as a single pay at maturity, not amortized. So both pieces of the deal front-load operational flexibility and back-load cash obligations. That was clearly designed so the factory can get filled and start generating the cash that will service the debt.
The key point is timing. We finally have the first real data point, a positive adjusted EBITDA quarter, and it arrived a quarter ahead of management's guidance. That moves the conversation from theory to evidence.
Before this, critics could say, nice plan, but prove it. Now, there's a concrete quarter showing the acquired asset is contributing to profitability. That doesn't erase the obligations. Refinancing risk and execution risk remain. But it changes the question to how fast the balance sheet can de-risk.
Which is a materially better question. Debt against a company losing money becomes scarier every quarter. Debt against a business that just turned the corner gets more manageable every quarter. So the narrative shifts in Cizzle's favour, as long as the factory stays filled and the contracts hold.
I mean, this setup feels familiar if you've watched the category. There are precedents. Monster and Celsius both started as small brands that hit an operating profit inflection and then expanded dramatically.
Right, but here's an important twist. Monster and Celsius kept things asset light. They outsourced manufacturing to co-packers and leaned on big distributors, which kept their balance sheets cleaner, but also handed away control of production and margin. Cizzle did the opposite. It bought the factory.
That ownership is the trade-off. Owning a factory means you capture manufacturing margin and have control over capacity and priorities. But it's only an advantage if you can fill the lines. So the fact that this quarter shows the factory generating meaningful revenue is the first signal that the gamble might be paying off.
Exactly. Ownership can be a lever for higher long-term profitability, but it also concentrates execution risk on the company. So it's a double-edged sword. We saw the take-or-pay customer commitments were part of the underwriting for the acquisition, and now those commitments are showing up in results.
Honestly, I was a bit surprised by how fast the guidance came in early. They guided positive adjusted EBITDA for the next quarter and hit it a quarter early. That suggests integration and commercial traction happened faster than planners expected.
Yeah, that's a good point. But let's be clear on risks. A single quarter is one data point. Refinancing when these notes mature, potential hiccups in customer volumes, and the usual volatility in beverage distribution all remain real risks.
Totally. And small beverage stories are famously volatile. Celsius had a brutal channel inventory correction a couple of years back. So even if you see a promising inflection, expect bumps and sideways movement as the story unfolds.
So where does that leave us?
The bear case anchored on leverage is reframed. The leverage was used to buy a productive asset, and that asset just produced a profit inflection early. The next few quarters will show whether that translates into sustained cash generation and a cleaner balance sheet.
Right. The right question now is, how quickly does cash generation accelerate, and how effectively can the company use that cash to reduce or refinance debt? That's what will determine if this becomes a growth story, like the big names, or an asset-heavy business that struggles with leverage.
Quick reaction?
Impressive first step. Cautiously optimistic.
Measured curiosity, same here.
Okay, let's wrap up.
Key takeaways. 1. Cizzle posted its first positive adjusted EBITDA quarter with revenue up 253% year over year. That's the inflection investors look for.
2. The debt financed an acquired factory, so it's acquisition debt, not survival debt. The financing was structured to give the asset time to ramp.
3. Ownership of manufacturing changes the playbook compared with Monster and Celsius. It offers margin and control, but concentrates execution and refinancing risk. The next few quarters will tell us how quickly the balance sheet de-risks.
Got questions? We'd love to hear them. Head over to stockalpha.ai where you can ask us anything, and we'll answer live. And while you're there, check out more market content.
Exactly. Thanks for listening to Alpha Insights. I'm Archer.
And I'm Hope. See you next time.